You can go ahead and start the recording. All right.
Thanks, Ashley. As Ashley said, my name is Wade Malchow. I work for Molson Coors and currently serve as our Ag Policy Committee Chair for AMBA. And during this last summer at a strategy session the AMBA team was having, we talked about some of the different things that AMBA could do to add value to our membership. And we asked the question, would we benefit from having a webinar and some learning opportunities around crop insurance? And the resounding answer was yes. Everybody around the table said we need to do more about making sure we understand crop insurance. Crop insurance, as we all know in barley supply chain, is a key part of keeping growers raising barley because it helps them manage their risk. And keeping those acres in production is critical to all of us. And so we need to be good ambassadors for the crop insurance programs and make sure we understand how they impact all of our businesses. So we wanted to bring this opportunity to the AMBA membership and others beyond. And so I hope you gain a lot from it and are better able to help your growers understand crop insurance and how it impacts your relationship. We have with us today, hailing from the Watson Associates team, Eric Henry and Jay Yates. And Watson Associates provides a lot of data and analysis that goes into the development and maintenance of these insurance programs. So nobody can speak to them better than this team. So with that, I'm going to turn it over to Eric.
Thank you, Wade. My name is Eric Henry. I'm with Watson Associates. Quick background, my early career, I spent 15 years grain merchandising, and the last 3 of that, it was in the Kansas City Board of Trade wheat pit when it was still there. So that was a while back. And then the last 21 years, I've been doing crop insurance. I worked for RMA for half of that, and the second half, 10 years here at Watson Associates. So I kind of got a varied background. I come from a Kansas farm and ranch, more ranch than farm on it, but we did do some small farming for the cattle, the usual things of all the different crops, corn, beans, wheat, sorghum, and oats were our main ones there. And the development team that we have, I'm one of the underwriters. Jay Yates is the other underwriter, and Jay has been, he's got more varied background than I. He's been from growing 22 different crops. I think we actually think it's more than 22 throughout his life, extension, grower groups, and banking. And he just joined us 2 years ago. He has one of the great things that Jay has is his knowledge of the production side and input amounts and different programs we work on. And he's been on these MBE on working on our materials, has been great on it. He's got a natural ability for it. And Richard Allen, Richard is the watch person I think has worked on every project for over 20 years that the development team worked on, the marketing team worked on. So we got quite a group here. I want to cover with you on the crop insurance program. I'll cover a couple slides on the overall program that RMA has, then the malt barley in detail, especially points that impact the contracts and the pricing and the quality. And then we'll finish up with preventive planning on it, because I know that's been a hot topic this year with the listening sessions going on with RMA. There we go. Change for everybody. Oh, did the slide change?
Yes, it did. Looking good.
Perfect. Thank you. And of course, I did it there. So the risk management agency, the insurance experience for all crops, it's kind of an amazing number now. It was a lot different about 20 years ago. So they're insuring 134 crops, 634 varieties, under 35 different insurance plans, which for malt barley, the 3 plans are, the 2 main plans are yield protection and revenue protection. And then for 2023, the liability was $181 billion, with almost exactly 10% of that in total premium at $18 billion. Of course, we know it's highly subsidized on those programs, which is good because it has encouraged a lot more buying than it did back before they changed subsidy rates in the early 90s. So that's 11.3 billion, and indemnities today are 6.4, but of course, a lot of that hasn't come in yet. Malting barley. So the acres insured, malting barley does participate in the insurance program. We are working on some training materials for companies, or for insurance companies and for agents, because we're only running about 30% of the malting barley acres insured under crop insurance. So we are working on that. We think there's some confusion at a few places about how the pricing works, if they get a contract price, and on the loss adjustment calculations. Things have been corrected this year for several of the people, but we want to make sure everybody's doing it the exact same way out there, and the farmers are getting what they're paying for. So thank goodness those were the few were caught this year. So insured, the all barley acres, I showed 2.1 million acres insured by RMA, 1.5 is malting barley, and then 430,000 were underneath the malting barley endorsement. There's a key item here that I want to bring out on the malting barley insurance, how RMA set it up, and this was a change in 2011 when I was at RMA that we did. It used to be a feed barley with a premium for malting barley. And in 2011, when the policy was redone at that time, it came out, they now insure malting barley as a type. And it can be insured underneath the endorsement or not insured underneath the endorsement. The key to that was it allowed them to build a malting barley APH database, which was very important because that had been done before. So that allows them to have all their records for malting barley in one area, not including feed barley or any of the others. The endorsement that they can insure under, which offers price and quality coverage, it attaches to a yield policy or revenue policy. This was worked on in the early 2010s. It was Watson Associates and Steve Edwardson, the North Dakota Barley Council, were the main ones working on it. And then also all the other grower groups, malts, everybody had been involved with this one. And all of them had been, all the groups were involved when we made the change that. What we were working on is to have a policy that was based, if it was rejected, then the loss adjustment started on the program. Before that wasn't quite what happened. Malting barley endorsement, one of the different things about it, it is reinsured by federal crop insurance, but is actually a privately developed product approved by them. It's called the 508H process. And a number of policies are out there now. I think there's about, on the 508Hs, there's 35 to 40 different ones going on out there from different companies. There's about 4 companies that build them. And what it allowed is Congress, when they went through in 2000 Farm Bill, what it allowed was for private companies to see some of the problem and be able to bring in a product to help fix it or to make something better. And that's why this is underneath called the 508H process. It is owned by, basically we're the developers, Watts, and then it's owned by the groups that supported it. North Dakota Barley Council is the main one there. And what this does, this enhances the price and multi coverage. So if rejected, then the loss adjustment starts right away. This program started in 2016. It replaced the old malting barley price and quality endorsement. That was kind of a mouthful there on that one. That used to be there. It is offered in all counties that one was in, and any new counties, the malting type is added to any new counties that the RMA regional office that they add to, which once in a while they'll add a spring or a winter wheat, or I'm sorry, winter barley county on it. And then at that point, we work with RMA to request that the malting barley endorsement be added. And I'll cover expansion a little bit later. Actually, sorry, next slide. So in 2021, actually the year before that, there became a lot more malting barley contracted and grown in Ohio. We worked with the grower groups. I know AMBA was involved. We had the maltster there that was involved, several maltsters. And we added to RMA that the malting barley endorsement to 35 counties in Ohio in 2021, and 2 more in Ohio and 1 in Indiana in 2022. This was for the winter type malting. We worked with RMA to get them to actually expand it to winter type. And then we worked with them to get the malting barley endorsement added. So they have price coverage on their contract price and they have quality coverage. We have seen additional expansions into the East Coast area. We've been having some requests that we are working on, and we continue to work on those. The Ohio, Indiana, we're expecting that they're going to be adding more counties in the coming years on that. So the key parts for them to buy the endorsement, and this everybody will be familiar with this, you have to have the small grains policy, which is the policy that RMA throws. It puts everything underneath their small grains. So you have barley, feed and malt in there, wheat, oats, rye, any of those small grains are included in there, and they have the rules for how to insure them. So malting type is insured underneath that policy. There's a yield protection, revenue protection, and revenue protection with HPE. The revenue protection with HPE, we include it, but less than 1% of the people buy that policy. Because revenue protection, the second one there, offers much more coverage. You get your revenue price. What happens on the revenue protection, they set a projected price in the spring, which for malt barley is your contract price. And then on revenue protection, if the price goes higher at harvest, they reset your guarantee from the projected price to the harvest. So if barley was $6 in spring, and then at fall, it was $8 on just the prices that RMA puts out, then $8 is used for the initial guarantee back in the spring. So they increase their coverage that way. The second one is on revenue protection. The usual method is if it's a lower price, say $6 in the spring, and it goes down to $4, then of course they use $4 to against your yield to calculate any losses on that. So revenue protection is by far the most popular one. Yield protection is just that. You get one price in the spring and it stays that way. If you have malt barley, you'd have the contract price in the spring, and it's not going to, you would get that price you would get that price for coverage. So the most popular is revenue protection on these. The producer does have to have one malting barley contract, and that is defined in the policy. Basically, the malting barley contract has to be with a maltster, and it will include the quality requirements in that contract. It must have those in there because this program, unlike the previous one, this ensures the contracted quality requirements. And that was one of the big differences with this MBE policy. We wanted to ensure what the producer actually is getting on their contract, and if it was rejected, that they get coverage. They get coverage based on that. So they must have one contract. They don't have to plant all malting type acres, and they don't have to insure all the malting type acres on it. The key thing is they have to have at least one contract to get malt coverage, and then on that contract, it could be acres or production. I know I've seen both. It kind of goes back and forth. I believe, Scott, tell me if I'm wrong now. I'm thinking that we are more on an acres type policy contracts now.
Most contracts, I think, are production-based, but I think for insurance, I think maybe it is acreage.
Okay, production-based. My fault there. I was trying to remember what it was the last time I saw one there. So there are in there, they could be either one. So other policy is covered. Then it can be a fixed price, a contract price, or it can be a premium or base. I use the term basis contracts. That was the area that I came from. But it could be a basis contract with the price to be set later. So the producer on the contract with the maltster has a large amount of flexibility. They can have the contract by acres of production. They can have a fixed price for the contract, or they can have a basis contract with the price to be set later. One key thing, if they have a basis contract and they haven't priced it by acre reporting date, then excuse me, then it will use the price. If they haven't priced by acreage reporting date, the price will be set on that date. That was one of the things. So they have to have it set by acreage reporting date, or the crop insurance is going to set it for them on that date. Most of them, many of them we've seen have come through or usually set before then due to the run up in the spring prices on the different crops.
Eric, when is that date typically about?
I had these up here. That is, okay, acreage reporting date. Jay, I'm thinking June 15th up into most of the growing areas.
Okay.
Jay, could you check that for me, please? Make sure I had that right when you get a chance. I did not pull that file up, but it should be around June 15th is sticking in my mind on the barley. The quality coverage, it must be insurable cause of loss, which the usual cause of losses for grains happens. You have your drought, you have your too much rain, you have sprouting, all of those are covered in that policy. And I do have, let me look here real quick. So example, the quality ones that we've seen, the protein, so it could be rejected for not meeting the protein levels. Plump kernels, thin, germination, blight, injured by mold and mold damage are separated out, injured by sprout, injured by frost, frost damage, and DON. So any of those things that's rejected, then the producer can file an insurance claim against that. That would be in the insurable causes of loss. I do want to cover, we had some changes with RMA a few, 3 years ago. Sampling. The samples must be taken no later than 90 days after the end of an insurance period, which is, sorry, most areas it's going to be November 30th. So 9 days after that. So they have to have the sample taken. It doesn't have to be graded until March 15th of next year. So that allows the maltsters to get the sample, and then I know they have a huge amount come fall time, and they can hold on to that, especially that'd be work for somebody with some on-farm storage, bringing the sample in. So it doesn't have to be graded until March 15th. Now, as of March 15th, if it's not graded, they don't get quality adjustment, but they still receive price and yield adjustment on that, on their production. Malting barley endorsement is different than the barley. So barley uses a proxy. They use corn futures as a proxy for the feed barley, which they just call barley now in the RMA materials. So it uses corn, which, you know, connecting corn to malting barley doesn't work very well. So when we worked for the industry and we developed this in 2016, they said the contracts are coming off the soft red winter wheat futures. September is the one that we're using. So that'll set basically the underlying price or the base price for the product. Then your contract price. So for example, if the price in the spring through the futures market for the month that it's watched, and RMA they would be watching, they'd apply their method to corn for barley on, that's just insured underneath them. That if it's set at say $6 and your contract is $8, then what you receive is $8. That's the insurance level there is for them. So we need the projected price involved in the calculation later when on revenue protection products. But say they buy a yield policy, then their insurance is not the $6, they receive the $8. And that's the key thing, it follows the contract. Now there's a limit to it on how high it can go. The limit, we have never hit it. The limit is 2.5 times the RMA price, which would be the $6. So at that point, it would limit out at $15 a bushel. Now, we've never hit any of those before, but given the way the markets have been the last 10 years, nothing is impossible anymore. But the key thing is that the contract price at $8, that's what the producer gets to use to calculate their guarantee and for their coverage if it's rejected. The spring type price is February 1 through 4. The other one, winter type, is in the fall. That's the Ohio areas and some of the PNW areas that we've seen. And then both of them have the harvest price is August 1 through August 31. Oh, jump there. And I just want to reiterate one of the things on the revenue protection policy, that if it's $6 in the spring and it goes to, goes to $4, that's a $2 drop that the insured is included in the loss calculation. The contract price, if they have a revenue protection policy, the RP policy, they get the same thing. They have their contract price at $8, and essentially there's a $2 loss, they would get that $2 loss as well. So one thing we want to make sure is that yield and revenue are both good policies, but revenue protection, it allows you to have the highest of the projected or the harvest price. And if you have harvest prices are low come fall, you get that coverage as well, and it all uses your contract price. That's what we use in the calculations. So it's very critical. Say they had nothing rejected, had good yields, good quality, but the price dropped from $6 in the spring to $4, they would get that extra $2. So even though nothing changed on the contract, the producer could receive an indemnity payment on just that revenue loss. And we do see those. That's one that about, I had the numbers last night, over 90% are revenue policies. So they do cost more. There's a higher premium for them, but getting the coverages that have revenue movement, two different methods, it works. A lot of producers go ahead and buy that. Malt barley endorsement is just a premium. For example, one of our regions, they pay an extra 3.5%, 3.4% in premium to their barley premium to get the malting barley endorsement. So it's really not very high, because a lot of times in most years or many years, the rejection is very low. It happens, there's bad years that come out, we have the sprout damage and there's more rejected, but otherwise the endorsement, it doesn't have a high premium because the rejection rates over long-term are not that high. Loss adjustment. There are some key calculations I want to cover for the contracts, and these were made a few years back. Come harvest time, an issue came up. This would be about 3 years ago. It was when the dog food, their malt barley had been rejected. I believe it was sprout that year. And the dog food places up in the northern areas were buying malt barley buying the barley put into their markets. So local market price became much more of an issue. And also the local market price, we wanted to reflect what the producer has. Say, for example, the price drops really low. We wanted to use that to reflect what was happening in their local area. So it had been in there before, but we made sure that it was understood that you could use the local market price in your area. If your grain is, if your malt barley is rejected, that we're going to use the local market price. There's a few rules in there they have in a handbook and in the policy about what local market price is. It's the usual things, within your region, they get the loss adjuster gets 3 bids from elevators or processors or maltsters, and they use that. So the good thing is the endorsement uses, if you get it rejected and you have to sell it, say, as non-malt barley, it's going to use the local market price in your area. Now, the reason they use 3 different prices, of course, is to make sure, they take the higher of the 3, but most of them are going to be very close together. That indemnity calculation was a huge change, and a lot of credit to North Dakota Barley Council, to Steve Edwardson, for going to DC and working on that with them as well on it. I don't think it would have gotten through without his help at that time. That gets us to the second one. You can reject if the malting barley on the contract does not meet the quality, something's out of spec, and the producer has to turn in the contract requirements and then also the rejection paperwork to the insurance company. But you can reject it and then buy it at a lower price. It's the discounted purchase price. Because I know some years that does happen, it doesn't meet the quality in the contract, but they do buy it at a lower price, then the discounted purchase price can be used. Now, one of the keys is that they compare the local market price to the discounted purchase price. So they'll use the higher of on that. But it does allow a producer to have it rejected and buy by the maltster, and then receive possible indemnity based on that change. And I know a lot of them have talked, it depends on the amount of malt barley that year. We've seen this a fair amount at places, and I think it was actually a very good change to add that in there with the local market price, because we want to reflect what the producer actually gets for it, and then get paid an indemnity because they didn't meet the quality requirements of the contract. It goes back to the rejection. All these key off of if the grain doesn't meet, the multi-market doesn't meet quality that's rejected, then all these kick in. And as always, I know a team's available. I'm always available for any questions. At the end of the slide, you'll have my email and phone number. So I know I'm throwing a lot here, and I'm kind of thinking as I walk through, wish I'd pulled that file or pulled that file. So just holler at me anytime. I know we have questions during this, but also I'm available anytime. If I'm not available, Jay and Richard will be there too. So.
And maybe we'll just take a quick pause here, Eric,
Yeah.
as we're transitioning over to prevent plant. What questions might there be about malting barley endorsement and the yield and revenue protection programs that are available? Anyone have questions they'd like to ask right now about those programs?
I had a question. Eric, you
Yes.
mentioned that the grading had to be done by March 15th. I recall having a discussion with you about actually having a settlement move to June 15th. I think that was a few years back. Does that mean the grading still has to be done by March 15th, but the settlement can be carried through to June 15th?
Correct. That is it.
Okay, so it didn't move the grading at all, just the settlement.
The settlement, correct. Yep, June
Okay.
15th, let's be settled by.
Thanks. And again, just to remind everyone, those are harvest samples. So those are samples that are submitted at harvest. They can be graded anytime until March 15th.
And this is Mark Black. Will you be sending this presentation out to us?
Sure will. Yep. Anyone registered for the webinar will be getting the recording.
Great. Thank you.
Yep.
Eric, my name is Zach Gaines. I work with Proximity Malt. Could you speak to whether or not damage from barley yellow dwarf virus is covered by these plans?
Okay, I'm going to need Scott. I'm going to need a little help on this one, Scott or Jay.
I would say it would only be covered if it causes one of the insurable losses, which are under special provisions, I think.
They are for price agreements. I have them here. So I was thinking we have blight damage, mold, sprout, frost damage, and dawn.
So if they affect one of those things, then it would, but the disease itself would not be covered as an issue. So if it tests positive for the virus, that's not a quality covered under the quality. It has to be detrimental effect on one of those quality factors.
Could you give me that disease again, please? I want to make sure I had it right. Yellow.
It's barley yellow dwarf virus. And I think, there are times in winter barley, if you have a mild winter where aphids can overseason and put some pressure and spread that virus. And I think there are scenarios where you can see consequences to both yield and possibly quality.
Okay. Yep, I'm with Scott. I'm the same way Scott is on that. We will do a little bit of work on that. Jay, we'll do some research, and then actually we'll get some more information back to you on that.
That would be great.
Scott, but let us make sure that there's not something down the road that we need to add as well, is what I'm thinking.
Thanks, Eric. Any other questions before we dive into prevent plant?
I just make the comment on diseases in general would just, as they affect yield or quality, that's the only way they're covered, except with the exception of Fusarium head blight, which produces the DON, which is a quality factor that's covered.
All right. Well, I think we should go ahead and dive into prevent plant unless anybody's got something else they want to jump in on.
Okay, preventive planning. So this one, I'm glad you asked for it, Scott. This one is, getting more more and more things happening with it here recently. So the preventing plan coverage, I'm going to cover mainly how it, a couple changes or possible change they've been looking at. And I'm going to cover how it impacts malting barley endorsement. There's a couple of items there. So this is when you're unable to plant insured crop by the final plant date or during the late planting period due to insured cause of loss, basically too much moisture. You still can do the too dry as well. That happens. And usually, well, the payment is based off your guarantee. So for malt barley endorsement, the preventing payment is 60%, and you can buy up to 5%, 65%. And the policy is very specific that the preventing payment is based off your malting barley endorsement price, which is your contract price. So that was one of the key things that we have going on there. And I'll cover a little bit later because RMA is looking at possible changes to the contract price that could impact malt barley that would not like to see, in my opinion. Just covered that. 60, not all crops are that way. Jay reminded me this week that, well, for example, cotton in the southern areas, I think 50%, and there are others that don't have as high as the 60%. They are looking at making a 10% option, but that's in the discussions right now. There's been numerous listening sessions on preventive planning this last 8 months, and that's one thing they're talking about is increasing possibly 10%, which for malting barley would be a 70. You could buy 60, 65, or 70%. The 1 in 4 rule. And I was on we call it the basic provisions team. The basic provisions are the 56 pages that apply to every crop out there. And there's a team of us 5 when I was at RMA. And it's amazing how many rules can be in a policy. There's a lot. So PP has gone to the 1 in 4 rule. And the 1 in 4 rule is that you must have at least in the last 4 years planted, insured, and harvested the crop on that. And that's a key change there because some areas with extended droughts, you're not able to be able to do they can do the planting insured, but not harvested. So in extended drought areas, which would be the western part of the United States, as many of you know, this could kick some people out of the preventing plant payment after 4 years. This is something that they went ahead and they actually made some adjustments that you can graze it. You can do a few of the things to meet that rule, especially for the western states because they extended drought. And then they're looking at should it be a permanent in preventing planting or should it not be in there? And that's what some of the listening sessions, that's one of the items that they've been addressing. Eligible acres. And there's an entire, preventing planting has an entire loss adjustment standards handbook, the LASH. It's very long. Jay was in it the last few weeks here. I think he said there's 9 examples for right here, eligible acres. One of the key points, and this impacts malting barley endorsement, especially if new people were starting to grow the malting barley and getting contracted. The preventing plan payment, you have to have the acres in previous years to show that you have grown that crop. That has been, for example, on malt barley, they're going to have to determine the maximum acres they had for the crop in the recent 4 years. And it's called a base of eligible PP acreage, the base of eligible PP acreage. Many times, this gets a little bit kind of weird. The preventing payment will not be based on your crop there. So let's go with somebody that, say they grew only wheat and oats and no malting barley there. They're going to malting barley this year. If they did not have a history to show that they'd grown malting barley, the payment will not be based off the malting barley and not the contract. It will be based on the other crops that they've grown before. And those use the projected price for the crop for that year. So if you have an entire base of wheat and you want to you go to malting barley, which is good. If you don't have malting barley acreage, you can't get a PP payment based on that wheat. and this gets really weird. There are a number of times that there is a list of crops for some areas. They'll have 5 or 6, and they have to go down the list, getting acres, past acres off of them to find the payments. And the payments are always as much or less. And most of the time they're less there. So I want to bring that up because I know there's some discussion new malting barley producers. It does impact them that if they don't have a history, for example, the expansion areas in there, that they cannot get paid on that. They can get paid on what they've grown in the past, say in Ohio, corn and beans, but it'll not be based on the malt barley. The 20 acre, 20% rule, that's in all the policies. You have to have at least that many acres for that. Excuse me. You cannot insure or get a PP payment. I'm sorry, you can't get a PP payment on ones for conservation purposes. They can't have a double payment on a crop. It cannot receive 2 PP payments. And you plant something afterwards at the end of the late planting period, unless it is a cover crop, you cannot get a payment on that as well. Now, RMA has come out. That's been one of the changes this last year on preventive planting for the western areas. The cover crop can be grazed, which is very good because they're short a lot of feed there, so they can graze that. That's been one of the changes they made and allowed that to happen. We've seen that more and more as RMA has embraced cover crops on many of these acres, that we've seen that they're allowing that, which is, as many of us know, there's no impact to the crop the next year, basically, by grazing or harvesting that way. The acreage cannot be harvested or grazed. That only applies to more of the eastern areas at this time. That rule has changed in 2021. The one I just talked about, western areas can harvest the cover crop or graze it. They can't have, if it was to remain fallow, it doesn't get a payment. There's numerous things that it does not get a payment on it. One thing I want to bring up, short rated acreage, which is mainly wheat, but barley in some of the areas where people are on the phone here, there is short rated barley. That's where, if they come out of for those that would have winter type, if they come out of the winter and decide not to harvest it and want to graze it or do something else with it, they only pay 1% of the premium. The premium payment in barley in the winter areas is they only pay 45% of the premium of the total premium. And then they can convert it to something else, to plant some other crop. Key, malting barley acres, it doesn't have to be insured, doesn't have to have a contract to get preventing planting payments. So it's just based off ingrown malting barley. The replant and preventing planting payments are based on the projected prices determined in the spring. For the malting barley endorsement, this is a key one. The replant and preventing plant payments, especially the preventing payments, they are based off of the contract price. Now I know I covered it a little bit later slide. One thing I want to bring up, one of the changes that RMA has been getting input on is making the preventing plan payment not allow contract price and go to the projected price only in the spring. The projected price of the spring is the one that RMA develops. And for us, it would be the soft, for the endorsement, it'd be the soft red ware and wheat futures in the spring. Right now, you get your contract price, which is usually over the projected price. The discussion is that contracts, their reasoning is not as they are not, there's no extra inputs put in at that time by the preventive planning. This impact is a concern because if it were to change your malting barley endorsement, you would see the preventing planting payments be lower because they wouldn't use your contract price. And I know they were looking at contract prices for other crops, that's about all they have is contract price for the most part. More of the APH crops, but malting barley gets caught in it. So that's something that we're looking at a bit more too. Scott and Ashley, I'll probably talking to you a bit more because that is a concern that we would get caught in a change like that. And our view is it should be based off the contract price for preventing plan payments the way it is right now. So I'll be in touch with you more on that. That became much more of a concern here as we're looking through materials, because I don't want us to get caught in something that's, going for the I want to say the contract only crops. I know I've kind of covered these. I went on through there. The 1 and 4, the contracted crops. Sorry on that. The other changes, one other change, they were discussing whether or not to use the harvest price, which it seems most likely they would stick with the projected price, and for us, hopefully the contract price. That's what we're working on. But I wanted to mention that out there to everybody. They discussed harvest price possibly being used. I could see them maybe doing that if it was higher than the projected come fall, but that's one that they need to get some more information from RMA about how they would handle that one. Those are the possible changes they've been discussing. They've had a lot of people listening sessions. Jay was down at his area about 6 weeks ago, weren't you, Jay? I may have missed. Oh, mute's on. So he went down to one listening sessions and talked with him. So we will continue to be involved in the PP discussions. That is all I have for now. If there's any question, I know I kind of run through PP. I wanted to cover how it impacts MBE. And of course, my biggest concern, my two big things. The biggest positive, it will use your contract price for preventive planning payments. And most people have a history. It's just expansion areas that we're seeing that may not have that history there. The second thing is one of the changes could eliminate contract price for preventive planning. And we do not want that because MBE gets caught in that. Actually, that's all I have.
Great. Well, thank you, Eric. So now I definitely would open up the floor to any questions related to MBE or prevent plan or just even general crop insurance questions, since we've got a good team of experts on the call today.
So I did want to bring up the answer to the question of the acreage reporting date. I answered it in the chat, but in case not everybody had the chat open. So winter type acreage reporting date is 12/15, December 15th. And for the spring types, it's July 15th.
Oh, thank you, Jay. I hate getting old. I really do. I used to have those memorized. I had the 15 right, but it was not June, July, which is better. So thank you very much, Jay.
What other questions do folks have?
Hi, this is Brian Schatz with Malting. I got a question about preventive plant. Say a grower has an act of God malting barley production contract that allows the grower to state their intended fields and acres on the contract. Say that grower states their intended fields and acres on the contract. Those intended fields and acres, is the grower allowed to prevent a plant those acres in that field to any commodity, say corn, soybeans, as long as it's a part of their base acres? That's my question.
I think and if I don't have this quite right, tell me I was looking at it. So you're looking at if they have the intended acres, they can get a preventing plan payment for the malt barley on those intended acres if they have a production history for the malt barley on those acres.
But let's say they have some production history for corn, soybeans, or wheat and barley, malting barley on that field. Even though it's written on our contract that that field is intended for barley on our contract, can the grower go and pick corn as preventive plant?
Okay, they can try to submit it that way. What happens is it's going to grab first all the malting barley acres in the history that are allowed for PP and the payment. So it's going to use all those up first. Then if they have more intended acres, say they had 200 in their history and they're going to plant 500 malt barley and they're not able to. It's going to use the 200 acres, calculate payment for that malt barley. Then the next lowest payment, whether it be corn, beans, or other crop, would then be used to match up to get up to the 500 acres that were not preventive planning. So they know they cannot receive a PP payment on their intended acres. They can only, it has to have a history with it. So for example, if they have a history for malt barley, 500 acres, and they contracted and intended 500 acres, if they have that preventive planning history, then yes, they can get a preventive planning payment for that. And then it depends on the final plant dates. You know, I'm thinking, here's the issue. And Jay, jump in on this if you see it. You've grown many of these crops. The issue is the final plant date. Malting barley is usually going to be later than corn. So they're not going to be able to use corn and say they're going to go to corn and get a preventing planting payment. They would have to have something that had a later date after malt barley. So if malt barley, the final plant date, let's say it was May 20. Say corn was April 30, they cannot change those malt barley acres and try to get a corn preventing payment on them because the final plant dates don't match up. It goes by the latest final plant date. In ours, say in the Southwest, and I know we don't grow any malting barley down this area, but they could say maybe they're going to grain sorghum because it doesn't have a final plant date until early July around here. So no, they could not, if they don't have the history, and it has to be at the final plant date. They couldn't just say, I'm going on these intended malt barley acres, I'm going to plant it, I'm going to switch to corn and get a PP payment on malt barley. No, they should not be getting a payment on that malt barley acres. And that's all worked out with the insurance companies. There's numerous rules and examples on this. I think those were Jay said there's 9 different examples in the handbook forms. So yes.
But I want to backtrack a little bit. Let's say it's the same scenario that I had mentioned, but the grower does not seed at all any crop on that field. The field lies bare, and the grower collects a corn preventive plant payment on that field. Is that allowed? Just wondering because yeah. I'm just wondering, is the grower allowed to receive a corn preventive plant payment if that field lays bare with no crop on it? But on our end, we have a contract that states that they intended to seed barley on that field because they have a land location and they have acres. Is the grower allowed to preventive plant that field as corn or whatever history he's had there if it lies bare?
I'm going to have to look into that. Please drop me an email. My email's on the page. Drop me an email with your email in there. Let me look into that, and then I'll get an answer to you. And then actually, I'll get it to you to send out to everybody. Let me look at that to make sure I have it right. I don't want to tell you something wrong on that. Unless you know right away, we'll look into that one. Because
so I've been trying.
Yeah,
I've been looking it up since you started asking the question. So I know where he's going with this. The corn probably has a higher indemnity for prevent plant than the malting barley. So they're wanting to do that, even though that field was specified. It's kind of gray, and I was trying to find the exact language, but there is some talk about not eligible acres, and I did not include this on the slide because it's complex and kind of gray area. If they did not have the substantial inputs in that for that field in that location, and so like if you had intended to plant it to barley, you had a contract for malting barley, you know, that would basically say that's a barley field, not a corn field, so the prevent plant should be malting barley. The language is not very strong. So I can see where somebody might push the limits and say, well, corn's higher, so we're going to say we prevent plant corn there. But we'll look more into that and give you a more definitive answer.
Thank you, Jay.
Way to go, Brian. You stumped the experts.
I have another question as well. Say say we get a dry year here, and I want to remind you guys, we live in the prairie pothole region. So there's a lot of sloughs and wet spots that farmers are able to farm through some years when it gets really dry, and they're unable to farm through them in wet years. So my question is let's say we get a dry year and the farmer's able to farm through historically wet spots in fields, since it was so dry. The following year, say it's a wet year, and the growers seeded barley to the field, but had to go around the wet spots that he had seeded through the previous year. Is the grower allowed to prevent plant the wet spots to any other crop as long as they have base acres for them? Even though the whole field is seeded to barley in those, that's my question, I guess.
And I'm familiar with that region, the prairie pothole region. The 1 and 4 rule originally came for that area. If they seeded, and again, I'll double check this one, if they seeded barley in all those acres all through that first year, or for that year when they seeded it, it's got to be planted. Well, the acreage has to be planted in 1 and 4. So the previous year they seeded all barley right through all the entire acres when it was dry, correct?
Let's say it's a different commodity, say it's corn or beans or wheat. And then they seed that following year when it's wet. And they do it, let's say they do have some history of malting barley on that field as well. Can they prevent plant those wet spots as corn? Because that's the highest payment. Rather than malting barley, when the whole field's seeded to malting barley, other than the wet spots.
Okay. That region, I'm thinking there's some different rules and the special provisions that apply to that. The actual documents that contain all the RMA published stuff, I believe the special provisions contain some of the prairie pothole region requirements. I will dig in those and get that back to you, because that's where the 1 and 4 came from, was the prairie pothole. So, and they blew it out to the other areas this last 2 years. My initial thought is, if they got I'm thinking on prairie pothole, it's got to be what you seeded the field in, is what I'm thinking that they had for a rule. I apologize. It's been some years back when they did that around 2008, I think. I will find out and get back to you on that. I'll let Ashley know as well. So we need to know if it's wet that year, if they seeded multiple barley in the field except the wet spot, can the PP payment be corn? I don't think it can be, but I will find out for sure. I'll dig into the special provisions that RMA has.
Good discussion. Glad we're able to kind of start breaking into some of these things that we need to get some clarification on. We have a few more minutes left. So are there any other questions folks would like to bring forward?
I got one more question too, is how is the actual production history policed? Is there somebody that's actually going out and measuring these bins and checking on these growers on their production?
They're out there. So there is believe it is, let's see, I think it's 3%. The insurance companies are required to review every year 3% of the policies, that they would go out and measure everything, measure the acres, check the production and those numbers. They do on the APH. If you file a claim, then yes, the adjuster comes out and they look at everything. So that's the first step in monitoring the APH. The second one is when the information comes into, it's the Kansas City RMA office where I was at. When it comes in, they have certain parameters based on the yields that, for lack of a better term, if it looks funny, it gets kicked out and it's reviewed by somebody on that. And a larger number of those, that's going to be 10 to 20, about 10% of those are kicked out. So yes, somebody has fallen up on them. Now, a producer that had an APH that was similar to the county yield and say to the neighbors, never had a loss. No, they're not going to come out and and really check them unless they popped up on a random search. But it is followed up when losses, definitely. When they have a 40% yield drop that year, loss adjuster comes out and they check that, and then production reporting for that year, they have to turn in production reporting material to support their yields. So now, of course, there's always, anybody could always try to mess with the numbers, but there are things in place. Now, if they determine that something happened and was wrong, they will go back the 10 to 20 years on the person. It's a pretty hefty penalty. Everything gets changed from, so if you had a bunch of indemnities paid out and you didn't have the production right, it'll go back through all those years and adjust them. So it is monitored. The acreage, initially, you have the FSA set the acreage when they do their survey. That's rarely ever checked once it's done the first time.
All right. Well, we've made, oh, sorry, go ahead.
How is preventive plant policed?
They have adjusters go out and check stuff. If there's been a preventing plant payment on it, I think it's the last 2 to 3 years. Preventing planting is monitored more because it becomes such a large program. Now, as far as getting into the rules that we're talking about here, I'm going to get some answers back to you. Only if somebody brought it up to them is probably when that would be caught. They have all the data there, but one of the issues I see that was brought up, they do not know about the contract for malting barley if he doesn't turn it in. So there may be some gray areas here where they getting malting barley contracts, but then they do the PP on corn. I'll look into that because that one had not come up before. So I am a little concerned about how that would be handled. That one I will look into. Otherwise, PP, it is monitored very closely. Anybody that has, if they start to have a PP loss, the adjuster comes out. And they do look at everything. And they do it timely and take pictures and everything. 20 years ago, there were some orchards, or not orchards, a place that had big rocks in the field that wasn't been planted for 10 years. So they did catch them. Most everybody's pretty good about it. But since it is such a large program, it's number 4 in their amongst all the crops. That one is watched even closer than just yearly APH reviews.
All right, we are at the top of the hour, and before everybody hops off, I just want to say thank you to everyone that was able to participate today, and especially to our presenters. And then I'll turn it over to Wade if you had any closing thoughts before we wrap up.
Just wanted to say thank you to AMBA staff for helping organize this and trying to help create opportunities for our AMBA membership to learn and develop a better understanding of this. I want to thank Eric and Jay for their time today, and thank you for providing your contact information, and just encourage everybody to reach out to them with questions, because it's a very complex topic, as we all saw today. So I'm sure there's more to learn. Thank you.
Yeah, we'll get the recording out to folks. And I think that Eric and Jay could probably hang out a little bit longer if anybody had some lingering questions, but we'll go ahead and close out the recording. And thanks for joining us.